Chart increasing financial and stock exchange news ultra deep dive script. February 12, 2026. Broadcast/YouTube/podcast script formatting, expanded analysis for every topic. Source note: your February 12th headlines are treated as the show rundown. Where I reference independent context, I'm drawing from public sources and your prior internal draft file to explain mechanisms and implications. Some of today's exact point-in-time price/percent figures in your rundown could not be independently verified in the sources retrieved, so I clearly label those as per your report. Cold open, midnight to 0:25. Anchor, energetic, crisp. Welcome to Financial and Stock Exchange News Deep Dive Edition. Today, we're going beyond the headlines: sector rotation inside equities, the Fed's no-rush stance, Bitcoin's ETF-driven microstructure, Disney's earnings plus buyback catalyst, Tesla's regulatory overhang, and two fast-moving consumer/resale trend stories that show how scarcity and attention can reprice value overnight. Anchor, quick legal read. This content is informational only, not financial advice. Segment 1: S&P 500 edges higher/rotation into industrials, 0.25 to 5:30. Anchor. Per your report, the S&P 500 rose 0.4% as investors rotated out of megacap tech and into industrials and energy. Today's key word is rotation, because rotation is what markets do when the narrative changes faster than the index level does. Voiceover explainer: slow, clear. Rotation is essentially portfolio surgery. Managers don't always sell the market. They sell parts of it, especially crowded winners, and redeploy into areas that either 1. Haven't moved yet, 2. Benefit from a different macro setup, or 3. Provide better valuation or earnings leverage. Deep context: what rotation usually signals? A shift toward industrials often implies markets are leaning into expectations for real economy throughput, manufacturing activity, capex cycles, logistics, construction, and infrastructure. Schwab's early February sector view had industrials rated outperform in its 6 to 12-month framework, reinforcing that this sector was already on many allocators' leadership watchlist. Schwab.com. At the same time, big-picture strategists have warned that concentration risk and high valuations can increase the odds that leadership broadens beyond megacap tech. Goldman Sachs highlighted elevated index concentration and valuation sensitivity in 2026, a setup where rotation can happen even without a crash. GoldmanSachs.com. Anchor adds nuance. Now, one important point: rotation can happen in two different moods. Risk-on rotation: money moves from defensive assets into cyclicals because growth is improving. Risk management rotation: money trims crowded growth exposures because yields rise or volatility returns, and reallocates to sectors with nearer-term cash flows. A public market wrap I found described the day as sector leadership in energy/materials/staples with pressure on tech as yields climbed, underscoring that rotation can be driven by rate expectations even if the tape looks calm. Monexa.ai. Semiconductors: why mild weakness matters even when it's not dramatic. Per your report, semis softened after a multi-week rally. That's often a classic positioning and sensitivity story. Semis can behave like a leveraged bet on both growth expectations and discount rates. When yields firm, markets tend to compress multiples on high-duration growth assets first, even if fundamentals haven't changed. What to watch: not advice, just the map. If rotation persists, you typically see improving market breadth, more stocks participating. Watch whether cyclicals lead without the index needing megacap tech to pull it upward. Watch whether industrials/energy strength is confirmed by earnings guidance language, capex, backlog, orders. Show continuity: your internal content tie-in. Notably, your internal February 11th draft also emphasized rotation away from megacap tech, though into defensives that day, showing how leadership can rotate again within 24 hours as new macro inputs land. Chart increasing financial and stock exchange news report, February 11. Docs, chart increasing financy, February 11 award. Segment 2: Fed signals no rush on rate cuts, 5:30 to 11 o'clock. Anchor. Per your report, a senior Fed governor said the Fed is not in a hurry to cut rates, pushing expectations toward late summer and nudging the 10-year yield higher. You cited 4.39%. Important verification note: transparent. I did not retrieve a public source that specifically confirms your exact late summer repricing and the 10-year close at 4.39% for today, so treat those as your rundown numbers. What I can ground is the broader policy posture and the why it moves markets mechanics. Macro context: grounded. A late January 2026 bank rate summary reported the Fed held rates steady at its first meeting of the year, keeping the benchmark range at 3.5% to 3.75%, and framed policymakers as wanting more convincing evidence on inflation/labor before resuming cuts. And the Fed's official calendar confirms the 2026 meeting schedule and cadence, which matters because late summer expectations map onto specific meeting windows. Bankrate.com, FederalReserve.gov. Deep dive: what no rush really signals. When a Fed official says no rush, markets typically translate that into three pricing consequences. 1. Front-end repricing. 2-year yields react more than 10-year. The market reduces probability of near-term cuts, lifting short yields. 2. Term premium/long-end drift. If growth remains resilient, longer yields can rise as investors demand more compensation for duration risk. 3. Equity valuation pressure at the margin. Higher discount rates compress valuations for long-duration equities, often high multiple growth in parts of tech, which can accelerate, you guessed it, sector rotation. Anchor connects dots. So if stocks were rotating out of megacap tech today, no rush Fed language is a plausible accelerant, not because tech is bad, but because relative valuation becomes harder to justify when rates are sticky. What to watch? Watch how the market interprets upcoming data prints relative to the Fed's dual mandate. Watch for cut timing to concentrate around specific FOMC meetings on the calendar. FederalReserve.gov. Watch whether the yield move is orderly or volatility-driven. Volatility tends to spill into equities faster. Segment 3: Bitcoin briefly breaks $59,000, then pullback, 11 to 1700 hours. Anchor. Per your report, Bitcoin surged to $59,200 before retracing on profit-taking, with spot Bitcoin ETFs still seeing inflows, though slower than earlier in the week. Verification note: the public sources retrieved in this run did not confirm the exact $59,200 print for today. What I can ground is the broader early February context. CNBC described Bitcoin selling off sharply in February 2026, emphasizing that crypto remains highly volatile and subject to rapid risk-on/risk-off shifts. CNBC.com. Deep dive: why ETFs matter for intraday Bitcoin moves. Spot ETFs change Bitcoin's market microstructure by introducing creation/redemption flows that can force real spot buying/selling. More traditional portfolio rebalancing behavior, month/quarter positioning. A tighter relationship between Bitcoin and broader financial conditions. So when your report says inflows continued but slowed, that's a demand still there, but urgency fading signal, which often produces exactly the pattern you described: push higher profit-taking retrace. Profit-taking mechanics: clear, non-technical explanation. Profit-taking isn't a fundamental thesis shift. It's a position management decision. Traders who bought earlier take gains into strength. That selling can trigger stop orders and short-term momentum flips. In crypto, thinner liquidity at certain levels can exaggerate the move. Regulatory clarity angle: how it influences pricing. Your rundown cites anticipation of upcoming regulatory clarity. In crypto, expectation can move price even before policy arrives. That creates a buy the rumor, sell the news risk where volatility spikes when actual details disappoint someone's positioning. What to watch? ETF flow trend direction: steady inflows versus swingy days. Volatility regime: does Bitcoin move like a macro risk asset, rate sensitive, or does it decouple? Whether rallies are broad, alts participate, or narrow, Bitcoin only, narrow rallies are often more fragile. Segment 4: Disney jumps on streaming subscriber beat plus $3 billion buyback, 1700 hours to 2400 hours. Anchor. Per your report, Disney rose 5.1% after stronger than expected streaming subscriber growth and announced a $3 billion share buyback. Your report also cites upgrades tied to improved margins and theme park performance. Verification note: The web sources retrieved here did not confirm today's exact move or the specific report. However, multiple sources established the strategic importance of Disney's streaming profitability trajectory and buyback signaling as market catalysts in recent years. For example, Investopedia reported Disney outlining $3 billion in stock buybacks and emphasized the market's focus on streaming operating performance and outlook language. Additionally, LionTree's early February 2026 weekly commentary flagged Disney as a key earnings narrative item in the TMT/consumer landscape, highlighting how investors were actively framing Disney within broader sector themes. Investopedia.com, LionTree.com. Deep dive: why subscriber beats can move the stock even in profit-first markets. Streaming is a scale business. Subscriber growth matters because it affects revenue base, obvious. Churn dynamics, stickiness. Content amortization efficiency, cost spread over more users. Pricing power, ability to raise ARPU without losing subs. But markets don't reward subs blindly anymore. The higher quality beat is subs up and margins improving and management confidence increases, guidance, buybacks. The buyback signal, what $3 billion communicates. A buyback announcement typically communicates two things. 1. Management believes the stock is an attractive use of capital relative to alternatives. 2. The company has confidence in cash flow durability. Even if the buyback isn't immediately massive relative to market cap, it changes the narrative, from turnaround in investment cycle to stabilization and return of capital. Theme parks, why they matter in the Disney equation. Theme parks are often Disney's cash flow engine. When parks are strong, they can subsidize streaming investment or accelerate deleveraging. That's why analysts frequently cite parks' resilience when they upgrade the equity. It's the ballast under the higher volatility streaming segment. What to watch? Streaming margin trajectory, not just subs. Price increases versus churn. Segment mix, experiences versus media. Capital allocation, does Disney keep returning cash or reinvest aggressively? Segment 5, Tesla regulatory inquiry over autopilot data, 24:00, 33:00. Anchor. Per your report, Tesla confirmed cooperation with a new federal inquiry into autopilot safety disclosures, and shares dipped 2.4%. Grounded context: the regulatory backdrop is real and ongoing. Federal scrutiny of Tesla's autopilot and related driver assistance systems has been extensive. In prior investigations, regulators have tied autopilot to a large number of collisions and highlighted concerns around driver attention safeguards. NBC News summarized NHTSA findings describing a critical safety gap linked to hundreds of collisions and noted additional probing of Tesla's recall/software remedy adequacy. Consumer Reports likewise described NHTSA opening a new investigation into the adequacy of Tesla's autopilot recall fix and argued that warning/control changes may not sufficiently prevent misuse. NBCnews.com, ConsumerReports.org. Deep dive: why disclosure investigations hit the stock differently than defect investigations. There are two distinct risk categories. 1. Engineering/safety risk. Could lead to recalls, software constraints, reputational damage, and product demand defects. 2. Disclosure/communication risk. If regulators examine whether internal testing data was represented accurately to investors, as your rundown states, the market often prices a different risk. Legal costs. Settlement uncertainty. Management distraction. And narrative damage to autonomy timelines, which are heavily tied to valuation expectations. Market mechanics: why shares dip even with cooperating language. Cooperating is neutral corporate language. Investors still price. Uncertainty on scope. Uncertainty on timeline. And uncertainty on outcome. What to watch? Whether inquiry expands to broader ADAS marketing claims industry-wide, this has precedent in how regulators gather data across manufacturers. Autosafety.org. Any changes to software constraints, monitoring requirements, or labeling language. How Tesla frames autonomy milestones in future investor communications. Segment 6, Viral financial product, BudgetBeam Smart Ledger, 33:0039:00. Anchor. Your report describes a compact digital budgeting device. BudgetBeam Smart Ledger, retail $39, resale $85 to $110, driven by scarcity and influencer demand. Verification note, important and transparent. I was able to verify the existence of BudgetBeam as a budgeting brand/product presence online, including a website and an app store listing, but I did not find independent evidence in the retrieved sources that it is a physical compact hardware device with the exact retail/resale pricing you listed. The BudgetBeam website describes an online budgeting platform. And the app store listing describes a budgeting mobile app, not a standalone device. Budget-beam.net, apps.apple.com. Deep dive, the economics of viral finance products, why resale spikes happen. Even without device verification, the pattern you're describing is a known mechanism. 1. Attention shock. A creator demonstrates an emotionally satisfying feature, real-time alerts. 2. Perceived utility plus novelty. Consumers anchor value to the outcome, it stops overspending, not the BOM cost. 3. Supply constraint. Limited inventory or distribution friction becomes the story. 4. Secondary market repricing. Resale becomes a proxy for demand intensity. RALTIME alerts. Why that feature goes viral. Budgeting is usually delayed feedback. Real-time alerts create immediate reinforcement, which feels like control, and tends to spread well on social platforms. What to watch? If the product is real hardware, restock timing will typically collapse resale premiums. If it's primarily an app, virality often drives subscription conversion instead of resale pricing. Segment 7 HAGH Value Resale, 2020 American Silver Eagle Proof Set, 39:0047:00. Anchor. Per your report, the 2020 Silver Eagle Proof Set resale surged, original $73, current $320 to $380, driven by collectors and low surviving mint condition. Grounded pricing context. Public coin pricing aggregators show ranges consistent with your stated resale band for certain 2020 Silver Eagle items/grades. Price charting displays values in the low to high $300s for 2020 American Silver Eagle entries in certain conditions, including figures around $320.70 and $388 in the snippet. USA Coinbook also provides coin-specific pricing context in notes proof variety values, example shown for 2020 as proof, illustrating how mint mark, grade, and variety can materially change market value. PRICetching.com, usacoinbook.com. Deep dive, why proof set resale can gap up. Coin resale spikes often come from a combination of 1. Mintage/availability perception. Even if total production wasn't tiny, the number of sets staying in pristine condition can be limited over time, especially if packaging/COA matters to collectors. 2. Grade scarcity. A move from raw to graded markets can reprice items sharply because top grades trade with scarcity premiums. 3. Narrative catalysts. Anniversary editions, design transitions, or key year collector narratives can bring new demand. 4. Macro overlay. When macro uncertainty rises, collectible precious metal items sometimes see increased attention, blending collectible and store-of-value psychology. Important clarity. Low surviving mint condition is plausible as a driver, but exact survival counts are typically not measurable without population reports and dealer data. The sources retrieved here do not provide a precise survival statistic, only market pricing context. usacoinbook.com, PRICetching.com. What to watch? Price dispersion between raw versus graded. Which mint marks/varieties lead the premium? Liquidity, are there many completed sales or just a few listings? Fire close, 47:0048:30. Anchor, wrap. Today's deep dive story is how narratives reprice risk. No rush-fed language can accelerate equity rotation. Bankrate.com, Schwab.com. Bitcoin's ETF era changes the flow mechanics behind sharp moves. CNBC.com. Disney's mix of streaming momentum and buyback signaling can flip sentiment quickly. Investopedia.com, Liontree.com. Tesla's regulatory/disclosure overhang remains a valuation-sensitive risk channel. NBCnews.com, ConsumerReports.org. Viral product and resale markets demonstrate that scarcity plus attention can create temporary price discovery events. Budget-beam.net, pricetching.com. Anchor, final disclaimer. Informational only, not financial advice. Optional production ADDONS included, no questions. B-roll suggestions per segment. Segment 1, Sector Heat Maps, Equal Weight versus Cap Weight Chart, Industrial/Energy Icons. Segment 2, Yield Curve Animation, Fed Calendar Graphic, FederalReserve.gov. Segment 3, ETF Flow Bars plus BTC Intraday Candle. Segment 4, Disney